Welcome, everybody. I'd like to welcome you all and thank you for being our guests at Bills and Sundberg. Every other month, we have this type of tax program where we pick a topic of interest, or at least that we hope will be of interest to our attendees. I'd encourage you in the future, if you'd like us to focus on any particular topics, to please let anyone in the tax department know, especially Hal and Jennifer, as to what topics you'd be interested in hearing about. I'd also like to thank all those people that are coming in from out of town. I see we've got a lot of people from out of town. I'm sure they came because of our seminar and had nothing to do with some other seminar that's going on tomorrow. I don't even know what that one is. But anyway, Jennifer, Hal, please proceed.
Thank you, Richard. Welcome, everybody. It's nice to see some familiar faces this morning, and also we've had an opportunity to meet some new faces as well, so welcome, and hopefully after the presentation and in the future we get to know you a little bit more. It's a great turnout, and as Richard said, has nothing to do with what's going on tomorrow. But before we get started with the topic today, I just wanted to point something out to everybody. And that is, if you see Hal over here sitting in with a little look of consternation on his face, it's because, well...
What did I do to deserve this?
There's a little bit of a running joke in our office, and there's a reason why I'm starting off the presentation today, and that's because if I didn't start off the presentation today, I would get no speaking time.
True.
So if Hal's over here going like this, you know that he's impatiently wanting to talk. So.
I would give you a little bit of time.
So he'll get his time, but I'm going to go first today. So what are we here to talk about today? Well, we're here to talk about the do's and don'ts of domestication of foreign trusts, and a little bit of sort of background as to why we're talking about this topic today. It's a good time for U.S. trust and tax lawyers, right? And the reason for that is because in the last year or so, we've seen a flurry of activity of trusts being set up in the U.S., and or being migrated to the U.S., and as many of us know in the room, the reason for that is the Common Reporting Standards, CRS. And there's been a lot of discussion, articles, and presentations given in the last year about CRS, how it relates to trust, and just a tad only on discussing domestication of trust. So we thought it would be useful to the audience to basically go through what we've seen in the last year or so, and also just in general the planning that we do for clients. Some of the planning issues besides CRS planning that we face on a daily basis when we're considering domestication of foreign trusts. Our agenda today is going to be first covering the basics of some of the U.S. tax issues that we need to sort of have as our building blocks before we can get into points number 2 and 3, which are the reasons and methods for domestication. When we talk about domestication, many people might not know what that actually means, so we're going to go through that. But to understand that, you have to understand the tax rules that are associated with it. And then what everybody probably wants to hear the most is point number 3, which are the planning issues over and above. And by the way, this is no presentation on CRS, all right? Because that's been done and overdone, in my opinion.
I'm obviously not allowed to comment.
No. Feel free to we'll comment on each other as we go along here. So let's start a little bit about the basic federal tax issues that we have to pay attention to. So we're talking about domestication. We're talking about the sort of conversion, if you will, of a foreign trust to a U.S. domestic trust, hence the term or term of art domestication. Well, in order to know whether you have a foreign trust, you have to first analyze and classify that entity. In our world, we have to, anytime we get a new trust or a client with a trust issue, we have to analyze and classify the trust, because in our world we classify everything. In our world, trusts are treated as entities, even though the pure trust lawyers in the room are shaking their heads and going, trusts are not entities, right? They're relationships. But for tax purposes, they're entities, and we have to classify them so we know how to tax them. And for determining when we have a foreign trust, so that we know to domesticate it, we are looking to a test that came into the code in 1996. 1996 was a big year for a lot of changes in the tax code, many of which related to international issues, and some of these rules we'll talk about as we go along. But we got our sort of objective rules for classifying trusts, and that is the court and control test. So a trust is a U.S. domestic trust if it satisfies both the court and the control test. These rules were designed to basically presume that all trusts start off as foreign. So you have to satisfy both tests. If you flunk either test, you are a foreign trust. So the court test is very simple. A court in the U.S. has to be able to exercise primary jurisdiction over the trust. Primary jurisdiction, we typically like to say, is the trust is governed by U.S. state law, and there's a U.S. trustee. There are some safe harbor provisions in the rules that you can maybe draft into to assure your status of satisfying the court test. And reverse, there's actually rules that say you will never satisfy the court test, and that's if it has what we call an automatic migration provision, which essentially just means that if the terms of the trust provide that if a U.S. court is going to take exercise over the trust, that there's a claim against the trust, for example, the terms of the trust say, in that instance, the trust is automatically supposed to migrate outside of the U.S., so that essentially the court couldn't exercise that jurisdiction. In that case, the trust is deemed to be a foreign trust on day one. And in fact, we just had a client situation, one of my clients, where I'm migrating a trust into the U.S., but I want to keep it foreign. So I'm designing the trust to actually have this automatic migration provision so that I assure myself of foreign trust status, interestingly enough. The other test is the control test, which simply means that all of the substantial decisions of the trust must be controlled by U.S. taxpayers. And the U.S. taxpayers for this purpose is U.S. citizens, U.S. green card holders, and those that satisfy our substantial presence test. Substantial decisions, there's no there's no all-inclusive list here, but the traditional substantial decisions of the trust that most of us are familiar with in the room are going to be distribution powers, investment powers, the power to hire and fire the trustee. So if one non-U.S. person holds one of these powers, it would not satisfy the control test. And in some cases, if you have an even number of people, the rules would say in that case you don't have you have not satisfied the control test because somebody can veto the U.S. people. So we have to pay attention to that also in our planning, as we'll get to later. Anything you want to add there, Hal?
Absolutely not.
Waiting patiently.
Doing good.
So after we have classified our trust as a foreign or a domestic trust, but given the topic of today's presentation, a foreign trust, we then need to know if it's a grantor trust or a non-grantor trust. And these are the ways in which trusts are taxed in the U.S. and how the beneficiaries may be taxed in the U.S. And a grantor trust is simply our sort of version of a transparent trust, where the grantor is treated as the owner of the income and the assets. So the grantor is picking up the income on their income tax return directly. And if the grantor is a U.S. taxpayer, that means all the worldwide income of that trust would be attributed to the U.S. grantor and would pay tax on, or would pick up that income on their 1040. And if it's a non-U.S. grantor, then any directly generated taxable U.S. source income is then attributed to a non-U.S. grantor. And how to determine when you have a grantor trust is you're generally looking to the powers or retained interest by that grantor. And just a little bit of, his grantor is not something that some of our friends in the room who are from offshore and are used to the term settlor or contributor. A grantor is, for our purpose, could be the settlor or contributor, but we're actually looking for the person who has made gratuitous transfers to the trust. So the trust instrument may say John Doe is the one that settled the trust, but really Jane Doe is the one that actually contributed gratuitously the assets to that trust. So for tax purposes, our grantor is Jane Doe, not necessarily John Doe. So we have to also, in our reviewing trust instruments, ask questions like who actually made the transfers to the trust. So as I said, how you have a grantor trust is there's usually some retained interest or power. And when you're dealing with U.S. taxpayers, it's very easy to trigger grantor trust status. And in fact, most often we are planning into grantor trust status because there's advantages for being a grantor trust, some of which we'll talk about on point 5 here. But when we're dealing with non-U.S. settlors or non-U.S. grantors, in 1996, another change came into the code, which limited the ability of non-U.S. taxpayers to set up grantor trusts. And now only those trusts can classify as grantor trusts if the non-U.S. grantor either has the power to revest trust assets in himself during that grantor's lifetime. While it's not directly defined, shorthand there would be a power to revoke the trust, or distributions may only be made to the grantor or the grantor spouse during the grantor's lifetime. So if we don't fit either of those two categories, then we have a non-grantor trust. And as we'll talk about in a second, non-grantor trusts are generally, in the foreign context, can be a recipe for a disaster. One of the advantages of being a grantor trust on slide 5 is that distributions from that trust are generally not taxable to the beneficiaries of that trust. So it's as if you're making tax-free gifts to those beneficiaries when the settlor or grantor is being able to pay the income tax associated to that trust. However, when you have a foreign grantor trust, as many of the accountants in the room know, the distributions to a U.S. beneficiary need to be reported on Form 3520 with the attached foreign grantor trust beneficiary statement, and we'll get into that a little bit more in our planning issues. So if you don't qualify as a grantor trust, then you sort of default into non-grantor trust status. So if you're not initially classified as a grantor trust, you are a non-grantor trust. Or if you have a grantor trust and when the grantor dies, or there is some other reason why during the grantor's lifetime it ceases to be a grantor trust, we become a non-grantor trust at that point. And a non-grantor trust is simply the reverse of a grantor trust. The trust becomes a separate taxable entity, and the trust income is generally taxed at the trust level unless it's distributed out and taxed at the beneficiary level. And in our tax rules, that the trust would receive a deduction for that distribution, and then the income shows up on the beneficiary's tax return. There's a separate tax form for U.S. trusts. They file 1041. But interestingly, in the foreign non-grantor trust world, there is no 1041-NR for foreign trusts. And what the instructions to the 1040-NR tell you, which is the tax return for individual foreign taxpayers, is that a foreign trust will use a 1040-NR. And what some may not understand is that a 1041 and a 1040 don't look the same. So the information reported on is a little unusual when you're using an individual tax return to report trust income. But we have plenty of professionals in the room that can help out with that. And so if you have a U.S. non-grantor trust, simply it's going to be taxed on its worldwide income unless it's distributed out, which is one of the planning considerations when you're considering domesticating a foreign trust. And then if you stay as a foreign non-grantor trust, like a non-resident alien, it's only taxed on its U.S. source income. As we'll talk about, one of the main reasons to domesticate is because of our throwback rules. For those not familiar in the room, one may be thinking, well, in your previous slide, if a foreign non-grantor trust is only taxed on U.S. source income, wow, I can be really creative, right? I can set up a trust offshore in a low-tax jurisdiction and only be taxed on the U.S. source income, but I can structure my investments in a way that there's no tax because it'll all be foreign source income. Yeah, the IRS and the U.S. Congress obviously picked up on that many, many years ago and decided to include these set of rules called the throwback rules, which essentially hit at trusts that accumulate their income and do not distribute it out currently. And in 1996, again, another change came into the code. And that change in the code basically said that the throwback rules, which were originally applied to all types of trust, foreign and U.S., now only apply essentially to foreign trusts and do not apply any longer to U.S. trusts, except, as we'll talk about, some historical foreign trusts that became U.S. trusts may be still subject to these rules. And so there is a great reason why becoming a U.S. domestic trust is important. And why do we care about the throwback rules and why are they so nasty? I don't want to get into the details because these can be some really nasty computations. But the main points that you need to understand is that accumulated income, when it comes out to a U.S. beneficiary, there's a set of ordering rules in the tax code. And first, D&I, or the trust's current taxable year income, is deemed to be distributed out first and taxed first. If there has been accumulation in the trust, which is U&I, undistributed net income, after you get through D&I, if the distribution is in excess of D&I, then you're deemed to pull out U&I, which would not be the case if you were in a U.S. trust. Sorry, we're getting some hints here. Okay. Once you get past U&I, that's only when we get to take advantage of tax-free distributions of principal. Whereas in the U.S. domestic non-grantor trust scenario, we don't have U&I to worry about. We go straight from D&I to tax-free distributions of principal. And as you see, I have in parentheses FAI, or fiduciary accounting income. That's because there is this sort of sub-ordering rule which would say that distributions that are in excess of D&I but not in excess of FAI would still do not draw out any U&I and could be considered tax-free gifts. And we'll talk a little bit about that in the planning issues. When the U&I comes out, there's hit with a throwback tax and a non-deductible interest surcharge. So there are situations when trusts have been accumulating income for many, many years, foreign trusts that are, the distribution of U&I that comes out could essentially wipe out the entire distribution that the U.S. beneficiary has received by the amount of taxes to be paid and the interest surcharge. So it becomes a very, very nasty ticking time bomb for U.S. beneficiaries. And the other disadvantage is that many of us know is that if capital gains are accumulated in that trust, they no longer receive the preferential capital gains tax rate, which is currently 20%, when they are later distributed out in a subsequent tax year. So another disadvantage and possibly another reason why we want to come into the U.S. Default calculation method we won't really talk about too much, but there is the IRS has provided us a special calculation method if we wanted to take advantage of it for determining the tax. It's not often used, but sometimes we look at it as a possible tool. But what is more important, I think, is that like distributions from a foreign grantor trust, distributions from a foreign non-grantor trust also need to be reported on Form 3520 with a foreign non-grantor trust beneficiary statement.
Let me stop you for a second, because
You couldn't wait.
No, I'm being told that the projector is projecting on my head, so I need to move, and I don't want that to be awkward. Is that better? Okay. Not that I don't want to be next to you. Better than having part of the presentation on my face.
Okay. So are we good? Okay. All right. So moving on the sort of the last basic tax issue I want to cover this morning is when we're looking at the tax consequences of the trust. Not only do we want to focus on the income tax consequences, we also want to focus on our transfer tax consequences. Transfer taxes being our gift tax, our estate tax, and our generation skipping transfer tax, or GST. And that's because we have special rules that basically say transfers into trust could be subject to gift tax, and we have special rules that say if a person makes a transfer to a trust and retains certain powers over that trust or certain beneficial interests in that trust, then the assets of that trust could be clawed back into the settlor's gross estate and potentially subject to U.S. estate tax. So when we're thinking about domesticating a trust, we want to think about, is that trust what we call excludable for estate tax purposes, so that maybe we want to preserve that, has the trust made an incomplete gift? So, for example, is the trust revocable, and therefore the assets are somehow already currently subject to estate tax? And do we want to plan to maybe make those assets excludable for estate tax purposes? I think many of us know this in the room. If you're a U.S. citizen or a domiciliary, you're subject to U.S. gift and state and U.S. GST taxes, on your transfers of your worldwide assets, and then non-U.S. taxpayers, U.S. citizens, and non-domiciliaries only pay transfer taxes on transfers of their U.S. situs assets, and some exceptions apply in what U.S. situs assets are, and that will be a subject of another maybe international tax breakfast presentation in the future. Wait. Hal, please proceed.
You sure I have your permission now? See, it is true that if I went first, Jen might not get a lot of speaking time. But what Jen doesn't know is that last night when we met and we were dividing up the slides as to who was going to cover what, she proposed to go first. And then I looked at the slides and I said, okay, that's actually a good idea. Then I don't have to talk about the things that are technical, and I can cover things that are more interesting. Okay. Can I have are you going to control the clicker? No? Okay. So Jen did a great job covering the overview of the law. And what I'm going to do is talk about the reasons why we consider domesticating, or why not to domesticate trusts. And then if we decide to do it, how we're going to do it. And then Jen and I both are going to cover planning issues and strategies that deal with or related to the domestication. What we sort of did here was commingle everything together. Where we see it in practice, and you probably see domestication issues too, is the typical case that we've had for years where a foreign person created a foreign trust. They've now died or for some reason the trust became a non-grantor trust, and there's some U.S. beneficiaries. Maybe all the beneficiaries are U.S. or just some of them are U.S. And we look at whether or not it's worth moving part or all of that trust to the United States. The second part is, it's been going on, but not as much as recently, where you have a foreign person who's alive, who has, let's say, a revocable trust. That's a grantor trust, as Jen mentioned. And now they're considering whether to move it to the U.S., but they either wanted to do that because there's some continuity of the trustee. If you start with the trust in the U.S., because we've been creating trust in the United States for foreigners for years, you start with the trust in the U.S., you always have the same trustee, no changes need to be made after the death of the settlor. Usually they're U.S. beneficiaries. In this case, in the second box I'm talking about, there would be U.S. beneficiaries or U.S. assets, some connection to the U.S. and reason why the trust would be here. And what we've been seeing over the last couple of years, prompted primarily because of CRS, is the movement of both that box 2, right, but also a new category of pure foreign trusts that have no connection to the U.S. whatsoever. So a foreign person that's created a foreign trust or wants to create a new trust, and they're considering whether it'd be worthwhile to move it to the U.S., even though there's no connection, no assets here, no U.S. family members. And the main reason they're looking to do that is to gain more privacy, because if they create the trust in a jurisdiction outside the U.S., chances are that, if they're from a country that participates in CRS, then there'll be disclosure in their home country. And that's being done in some cases for good reasons and in some cases for not so good reasons. And in fact, CRS states that you can't do planning to specifically avoid CRS. There's an anti-avoidance provision within CRS, the CRS rules. And, the good reasons are that people actually are moving some assets here maybe, they want some protection. And in their home countries, they're compliant, meaning they've paid everything they have to pay in connection with that trust. They continue to do that. And they've reported everything they had to. And in some countries, there is no tax and there is no reporting in connection with a structure like that. So, for years we've been doing compliant planning for people from Latin America, for example, where they create a trust outside their home country. There's no reporting and no taxation. There's deferral according to their country's laws. And now CRS comes in and it causes over-reporting. In other words, CRS is causing more reporting than what the home country actually requires under their laws, which doesn't seem fair. If I lived in a country where I was totally compliant and reporting everything I had to, and then some foreign body told me, well, I now have to report extra in my home country, and my home country didn't require that in the first place, I'd be pretty upset about that. But there's the other side that's not so good, where you have people that have undeclared assets. They don't want to participate in an amnesty in their home country, or there isn't an amnesty to participate in, and they're trying to move here to continue to hide their assets, and that's got a whole set of problems, but that's outside the scope of what we're going to talk about today. So when Jen and I and other people that are part of our team have a client that's in any of these situations other than the third box bad category, we think about whether or not it's worth domesticating. And on this slide and the next slide are just a list of reasons why we would consider domesticating. I'm going to go through those. The first is that, as Jen mentioned, when a U.S. person is a beneficiary of a foreign non-grantor trust. So foreign client creates a trust. It's either irrevocable and not structured properly to be a grantor trust, or they've now died. So let's assume the whole trust is a non-grantor trust, and there's at least one U.S. beneficiary, maybe more. If that trust accumulates income, Jen told you that the throwback rules apply, which basically means that there could be a higher tax on that income if it's accumulated when it's eventually distributed to a U.S. person. So by moving the trust to the U.S. and domesticating it, you eliminate those rules. Those rules don't apply to domestic trust. They used to many years ago, but they don't anymore. So if a U.S. trust, a domestic trust for tax purposes, means the trust is taxed on its worldwide income. So if the trust earns $100 of profit, it pays tax in the U.S. on that profit, all of it. If it makes a distribution, let's say it makes a distribution of $40 to a beneficiary, a U.S. person, the U.S. beneficiary pays tax on that $40, and the trust pays tax on the $60 that it keeps. Right? So that's the way a domestic trust is taxed. The accumulated income will always be taxed, so there's no need for these throwback rules to apply. If we set up the trust as a foreign trust, then the trust distributes the $40 to the U.S. person. That's taxed to the U.S. person, but the foreign trust isn't a taxpayer here, so it doesn't pay tax on that $60, assuming it's not earned from a business being conducted in the U.S. So that $60 gets accumulated, and then it's subject to that interest charge, and it's recharacterized as ordinary income. If it was once capital gain, it's now taxed at ordinary income rates. So the tax on that could be much higher than it would have otherwise been, because the IRS isn't getting its tax dollars when that profit is earned. So there's a penalty because they're getting paid later than they want to. So we do a lot of planning for this UNI, which is accumulated income. But if one of those plans is to maybe move the trust to the U.S. so the rules don't apply at all. And that's usually beneficial for a trust that's going to accumulate income. Reducing reporting. So if I'm a beneficiary of a foreign trust and I receive a distribution, I have to file Form 3520, like Jen said. And I have to report to the IRS the existence of that trust, what I received, and what it constitutes, what type of income gain, the full breakdown, what expenses the trust had. And I'm not saying that doesn't have to that there isn't something similar for domestic trust, but I also have to file a Form 8938, which is attached to my income tax return to disclose the distribution again. I may have to file an FBAR if the foreign trust is foreign bank accounts, which is a foreign bank account report. There's lots of disclosure here, and there's huge penalties or potentially huge penalties for not getting it right or not doing it at all. And I've unfortunately seen, and I'm sure Jen too, lots of examples where clients were using an accountant in the U.S. that didn't really understand these rules and didn't do things properly. And ultimately, it's the client that suffers because they're subject to penalties and don't really have enough recourse against the person who got them in that situation in the first place. So by moving the structure to the U.S., it also makes all of the reporting a lot more simple, and it takes most of the penalties off the table. No questions.
Assuming an accumulation in a foreign trust, let's say 40% of the income gets distributed to the U.S. beneficiary, 60% stays as accumulation. Does it get taxed in the foreign country within the trust?
So
Wait, just make sure you repeat the question.
Yeah, I was going to.
Okay.
No.
I have to give him a hard time.
I tell you, this is the last time we're going to present together. Yeah, exactly. So the question is, if the trust is a foreign trust for tax purposes, it earns $100, 40 is distributed out to a U.S. person and taxed, and the $60 gets accumulated, is the $60 taxed in a foreign country? And I think that depends on where their where the trust is resident and what type of tax status it has in that jurisdiction, and also where the settlor, transferor, and beneficiaries are tax resident. Right? It has nothing to do. The U.S. won't control that. There may be foreign withholding tax on the investments. Right? So if there's a dividend paid by a company incorporated in a foreign jurisdiction, there's typically a withholding tax on that anyway. But whether the trust gets taxed on that $60 or the beneficiaries or settlor or transferor get taxed is a matter of foreign law.
Okay, so then my follow-up question would be, in that case, let's say there was some sort of tax paid at the trust level, foreign. Is there any sort of credit that would apply later?
I'm going to get to that, but the question was, well, if there is a foreign withholding tax, is there a credit to the U.S. beneficiary? The answer is possibly. okay? In certain cases, definitely. So if the trust earns, let's say the full $100 had a withholding tax of $10, right? So let's say a foreign company paid a dividend to the trust of $100. That was the only income. And now 40 of that goes to me. I get a $4 credit in the U.S. for the taxes that were withheld. In other words, if there was $10 of tax withheld and I receive 40% of the income, I get 40% of the tax credit that I can declare on my tax return here. With regard to future distributions, that credit is potentially lost. Okay, there would be a mismatch potentially also of the timing of when the tax was paid and when I actually get the income. Right? Jen and I were actually talking when we were putting this presentation together about the U.S. withholding tax. So in that same example, let's say the U.S. withheld $10 of tax, and I receive 40%. Do I eventually get, because it was the U.S. being paid, not a foreign country, do the beneficiaries eventually get the benefit of that? And we think that the answer to that is probably more yes than no, but the issue is, or the complication is, that there's no real place on a tax return for me to put the $4 of U.S. withholding tax, right? And I'll get to that. Actually, this is a good bullet point to cover this. So what this bullet point 3 says is that another reason to domesticate, I was actually forced in a client matter to prove to a trustee that we had to domesticate a trust, that it was really bad for this particular client to leave the trust foreign. And a lot of times these discussions come up where we talk to the trustee and, they're not so happy about it because they're going to lose the business. Some people create some trust companies have domestic counterparts so they don't lose that business, right, when it gets domesticated. But a lot of times it's just a casual conversation, or there's some technical analysis done, and if it looks like it's a situation that should be domesticated, eventually gets domesticated. I had a case where the client's father had put certain family employees in charge of the structure as board members of a foreign foundation, and I had to prove to them that this needed to get domesticated. And one of the issues that came up was the mismatching of reporting. So if I own a brokerage account here in the U.S. and it earns a profit, it gets reported on a 1099 to the IRS. So I get a 1099 and the IRS gets a copy of my 1099. So the IRS knows exactly what I've earned for the most part. Or if I'm a partner in a partnership and I get a K-1, which is the form that I would get to show my portion of the profit and expenses of the partnership, the IRS also gets a copy of that form. So if I report all that income and gain and profit from the partnership on my tax return, the IRS will go and try to match it, right? So they have something in their system that matches what's on my return with what they have. If instead, with a foreign trust, I get a distribution and I have to report that on a Form 3520, I attach to that Form 3520 something called a beneficiary statement. And the beneficiary statement will list just the gross number of income, interest, dividends, capital gain, long-term capital gain, short-term capital gain, maybe PFIC income or gain. There'll be a breakdown of everything on that beneficiary statement. And that gets attached to my Form 3520. But the IRS doesn't input that in their system, and they don't have the details of how that income was earned. So if I get audited, then how do I prove to the IRS that this is exactly what I should have reported, right? The other thing is, going back to the withholding, so where I've seen this come up on audit is that as a beneficiary, I'll try to take a credit on my tax return for the U.S. tax that was withheld, right, or the foreign tax, but foreign tax credit, U.S. tax. But let's talk about the U.S. tax that was withheld. So the IRS agent will say, well, how do I know that Hal Webb paid tax to the IRS through withholding tax? And my representative would tell the agent, oh, well, there was U.S. tax withheld on this investment owned by a foreign trust. okay, well, show me something on paper that says, and it's usually what's known as a Form 1042, show me something that says that the IRS got taxed specifically for this trust. And most foreign financial institutions can't produce those forms because they invest under their own umbrella or in bulk. And they can't give you the Form 1042 that shows specifically that taxes were withheld for that trust or company that's owned by the trust so that I would get the benefit of it. So we've tried different ways to prove that to the IRS. So another reason to domesticate is, it doesn't necessarily mean the whole structure has to come to the U.S., but it would be better. As long as the investments are in the U.S., it makes it easier to have that proof so that my tax return as a beneficiary would match up with what the IRS has in its system. Rodney?
Not talking about foreign tax, but where you've got UNI, okay, and let's say you've got 1 out of 4 beneficiaries of a discretionary trust. How do you establish with the IRS what the share allocable back through UNI? I thought there was a wrinkle that the IRS actually considers all that UNI to belong to a single U.S. beneficiary unless you can prove otherwise.
So, well, that's a whole different issue. What Roddy's question is...
It's very important, isn't it? The accumulation of these foreign funds.
Right. Roddy's question is that if there's UNI distributed to a U.S. person, and there's or how do you apportion that or attribute it to the U.S. beneficiary, right? Not counting the withholding tax. And if only one beneficiary is U.S. and there are 4 beneficiaries, the other 3 are foreign, how do you determine what portion of UNI went to the U.S. beneficiary? Normally, what we do, there are lots of methods that you can do that, but normally what we do is we allocate everything proportionately to the distribution. So we would take the total amount that was distributed, right, and then allocate the U.S. let's say I receive 30% of the distributions. Then theoretically I receive 30% of the UNI, right? But in the U.S. we have ordering rules. And DNI, which is current income, comes out first. UNI comes out second until that's exhausted. And then tax-free capital comes out. Those are the general rules. And so we use an apportionment because that's the fair thing to do, right? If you allocated all the UNI to the U.S. person, then that would obviously be a bad result. So we would try apportioning it pro rata. Now you see why Jen would never get time to talk. I haven't even finished one slide yet. Right? So another thing that came up in this example where I had to prove, a client matter where I had to prove to the trustee to domesticate, is it was a unique situation where in 1 year the trust had $250,000 of foreign taxes withheld. But the trust had an overall net loss. So on one hand we have what we think is a $250,000 tax credit, foreign tax credit in the U.S., right? The beneficiary got a few $1 million that year, and the accountant wanted to take a credit for the $250,000 of tax withheld. The problem is that you can only take a foreign tax credit in the U.S. if that tax was paid on income that you're reporting on your tax return. And in this case, because there was no income, there was actually a net loss, the client lost the benefit of that full $250,000 tax credit. And going back to your question, when you carry forward essentially a foreign tax credit, really it's supposed to be used by the trust in the future, not by the beneficiary. And so in this case, the trust is never going to be taxable directly on its income as a foreign trust. So the client and the trust lost the full benefit of that foreign tax withheld. Loss carry forwards. If I'm a non-resident alien and I invest in shares of Apple and I lose money, not that Apple probably always goes up, but think of a stock that actually goes down in value. So you buy something for $10 and you sell it for $7. You have a $3 loss. In the U.S., if that happened to me, I can take a loss on my tax return, right? I can take a $3 loss on my tax return and offsets my income. If I'm a foreign person, I'm not taxed on my profit. So if I sell shares of Apple or Microsoft or some other U.S. company and I realize a profit from that, I'm not taxed on it. So foreign individuals don't get to use capital losses because they don't have any capital gain to offset it against. And with a foreign trusts are taxed in a very similar way as a foreign individual. So if a foreign trust has a capital loss, let's say it has interest and dividends for the year, but it has capital losses, and those capital losses don't offset the interest and dividends. So you would carry forward that loss. The question is whether the trust or the U.S. beneficiaries can actually use that loss in the future. Let's say in the next year, the trust has a capital gain. So what we would try to do is we would say, okay, before we prepare the beneficiary statement for the U.S. beneficiary, we're going to take that loss from the prior year and we're going to offset it against this year's capital gain, right? So that the beneficiary has, or the trust has, less D&I, it has less current income, because capital gain is included in the current income calculation for foreign trusts. So it's not clear whether we can actually do that, because if a foreign non-grantor trust is taxed like a non-resident alien individual, and a non-resident alien can't carry forward losses, how could a foreign trust? So by domesticating, you eliminate that issue too, and you guarantee your beneficiaries that they're going to get to use any losses that get carried forward. The last point on this slide about confidentiality, we sort of talked about. So the U.S. is not part of CRS, so clients may get more confidentiality, if there is such a thing, or privacy, by having a structure here than having a structure outside the U.S. Also, there wouldn't be like a FATCA analysis and reporting to jurisdictions where the trust is formed. So just globally, not just a CRS issue, but globally there would be less reporting of what this trust has or what the family has set aside for them. Believe it or not, clients are actually interested now in doing things in the United States. For almost my entire career, clients have done whatever they could possible to avoid the United States. They didn't want to be subject to any potential new laws that could come into effect that could negatively apply to them. They felt more comfortable dealing with small offshore jurisdictions and institutions that maybe they've had a connection with, or even finding new institutions. But they wanted at all costs to have nothing to do with the U.S. until it was absolutely necessary. And now there's a shift where clients actually see the benefit of having the protection of the U.S. laws and regulatory system, dealing with the service providers that we have here. And I'm not saying that's every case. You know, there's still valid reasons to form structures outside the U.S., and we're still doing that for a lot of clients. But it's now where clients are starting, they're more open than they have been in the past to have that U.S. connection. Security is another, sort of all connected. I'll try to make this a little faster if I can. Access to investments. Sometimes, and this works both ways, to domesticate or not to domesticate. Sometimes you need to have a U.S. person to invest in a certain type of product. Sometimes certain products are geared only towards foreigners. So that could work both ways. And then I mentioned the continuity of trustee, where if we do domesticate, chances are we're domesticating to a different trust company, a different trustee. Sometimes I mentioned foreign trust companies have a U.S. counterpart. Most of the time they don't. And if it's individuals that are trustees, then almost certainly we're going to have different individuals or a trust company as trustee if the structure is moved to the U.S. The income tax efficiency, it may be, believe it or not, that the tax rates are more favorable if the trust is domesticated than if it remained outside the U.S. For example, we have a withholding tax of 30% that's withheld on dividends paid to foreigners, and a domestic trust would only pay 20% on that dividend. And then directed trust rules, a lot of the jurisdictions where these trusts are being formed, so Florida, Delaware, Nevada, Wyoming, South Dakota, are really the flavors of the month, probably less Florida than the other jurisdictions, because it's very expensive to form a trust company here, so you don't see a lot of new trust companies being opened here. And if an institution has a trust company here, and they have one in Delaware, they probably would prefer, or Wyoming or South Dakota, they probably would prefer to use the other one anyway. But we have, these jurisdictions have directed investment power rules, where you can give a specific person the power over investments, and the benefit to the trustee is that there's less potential liability to the trustee, which brings down the fees usually, depending on the structure. I know I'm taking too long. So why not domesticate? And honestly, I jotted down just a few reasons. I probably could have thought of more, but these are just some of the reasons why we would say don't domesticate. We've been talking about U.S. beneficiaries. We haven't yet talked about the benefits to the foreign people, right? So usually these structures have some foreign people that are beneficiaries or have some sort of tax consequence in connection with it. And so if you have a trust that has a mixture of U.S. and non-U.S. beneficiaries, or only non-U.S. beneficiaries, maybe it'd be better for them from a tax point of view to stay outside the U.S. Or if the trust structure is brought to the U.S., then the trust would be structured in a way so it's treated as a foreign trust, governed by U.S. law with the U.S. trustee, rather than a domestic trust. Asset protection is another. It's probably one of the more important reasons. Joe?
Just before you leave that other question, or the first point, under our tax treaties, like if it's a U.S. trust, pays taxes here, and then distributes to a foreign beneficiary, is that covered by the tax treaties where to avoid double taxation?
But normally there wouldn't be taxation. So if it's current income, it normally wouldn't be taxed at all. If it's a domestic trust, the trust gets a deduction for the distributions to beneficiaries. And so if the trust earns $100, distributes $40 to a non-resident alien, and that non-resident alien would ordinarily not be taxed on that type of income, then there's no tax. There may be tax in the foreign country, in the home country where that person resides, but the trust itself would get a deduction of $40 and only pay tax here on the $60 difference. Okay. For asset protection, I actually had a situation, getting ahead to one of the other slides I'm going to cover, sometimes trusts are set up in a way where they're flexible, right, so that they don't necessarily have to domesticate. And other times, there's certain trust companies that like to put provisions in their trusts that make it mandatory. So that the trust has to domesticate upon the death of the settlor, for example. So once the settlor dies, the next day the trust is already moved to the United States, theoretically. Okay? In other cases, it's a discretionary decision, typically made by the trustee. And I had a situation where settlor is foreign, died, all beneficiaries were U.S., and our natural reaction was, okay, well, let's at least consider moving the trust to the U.S. as one of the strategies. But it turned out that the family was being threatened with a lawsuit over something. And if we kept the trust where it was, the foreign country had very good, where it was formed, had very good asset protection laws. And if we were concerned that if we moved the trust to the U.S., even if we move it to a jurisdiction that also has asset protection laws in the U.S., that we might lose that potential benefit. And that was one reason why we decided in that case to keep the trust foreign. Another similar issue is that most offshore jurisdictions where trusts are formed, some are in onshore like New Zealand and the UK, most of these jurisdictions have laws that guard against forced heirship or community property laws. So it would say, even though in Brazil, when the settlor dies, half the assets go to the spouse and half go to the kids or spouse and kids, whatever the forced heirship rules are, because the trust is here in our jurisdiction, we don't care about those rules. And we're just going to distribute everything in accordance with the terms of the trust. Well, if the trust is moved to the U.S., there's not even if the particular jurisdiction may have a similar law like that, there's not enough precedent to maybe feel comfortable that you have that protection. And so we consider in any planning the difference between what the trust says and maybe the letter of wishes say and what home country laws would otherwise provide if there wasn't a structure at all. So how do we domesticate? There are really two ways to do it. One way is a decanting, where there's a distribution from the foreign trust to the U.S. trust. And again, in most cases where that would happen, the U.S. trust would be treated as a domestic trust for tax purposes. And that would be somebody exercising a power to make a distribution to the domestic trust. So typically it would be the trustee, but maybe somebody has a power of appointment or other way that they can get the assets into the domestic trust. The other is to take the whole trust itself and move the entire trust to the United States. And that usually entails changing the trustee, changing certain power holders, changing the governing law of the trust, maybe making administrative amendments to the trust documents so that the trust can conform to the new governing law, right? So there are big differences between those two. And again, you have to decide when taking a foreign trust and moving it, do you want that new trust, the U.S. trust, to be a foreign trust for tax purposes or a domestic trust for tax purposes? If it's going to be a domestic trust for tax purposes, then all substantial decisions have to be made by U.S. people. If it's going to be a foreign trust for tax purposes, then at least one substantial decision has to be made by a foreign person. You want to go over this, or you want me to cover this one?
Thank you.
Okay. So I'm just going to start with the planning issues, and Jen's then going to pick up with the rest of them. I sort of discussed this. When you domesticate, you think, well, do we want this to be foreign or do we want this trust to be domestic? If it's in the first box I mentioned where a settler is dead, all the beneficiaries are U.S., and you're going to move the trust to the United States, then almost always that would be treated as a domestic trust for tax purposes. That would be the primary reason why we would move that trust here. But if the settler is still alive, let's say foreign client, revocable trust, still alive, and we move the trust to the United States, we probably don't want to, and almost never want to make that trust a domestic trust for tax purposes. We want to keep it as a foreign trust for tax purposes, which means none of the income and gain will be taxed here unless it was otherwise taxed when it was a pure foreign trust. Right? We just want to keep the same characterization from a U.S. point of view. Even though we now have U.S. governing law and U.S. trustee, it's still a foreign trust for tax purposes as if it was still in the jurisdiction where it came from. Right? We're actually seeing now an interest from people from Mexico, for example, where they want to create a structure here and pay tax here. Because if they pay tax here, then they don't have the reporting in their home country, right? Because if they pay, I think it's 75% of the Mexican tax rate to another country, then they don't have tax in Mexico on that income or gain. I mentioned the difference between making it automatic or discretionary, so I'm not going to cover that one. And choosing whether to decant, which means make a distribution to the U.S. trust, or take the whole structure and move it. Most of the times we prefer to move the whole trust because then we don't have any tax issues to consider. There shouldn't be any reporting. It shouldn't trigger any sort of income tax consequence. It shouldn't stir up any sort of estate or GST tax consequence. Moving the entire trust to the U.S. is better. But that usually works only when all the beneficiaries are U.S., because if there are any foreign beneficiaries, then making a foreign person a beneficiary of a domestic trust probably doesn't make a lot of sense. Okay? Probably wouldn't be a good result or outcome for that foreign person. Like Joe was mentioning, that person would get a distribution from a U.S. trust. There would be a deduction for it, but there are other issues in reporting that would be unnecessary. And if the income is accumulated and later distributed to a foreign person, it would have already been taxed, right? And then for decanting, when a foreign trust makes a distribution to a U.S. trust, it's treated like a distribution. So it carry out all the U&I that Roddy was talking about. The trust is any U&I, and the foreign trust makes a distribution to the U.S. trust, the domestic trust, it's treated as receiving all that U&I. Or it can be treated as having sold all of his assets. Usually the trustee doesn't make a transfer in kind of its assets. Typically it would sell all the assets, convert it to cash, and make a distribution to cash. We had one situation where we actually wrapped the investments in an LLC and then distributed out interest of the LLC so we can keep the investment portfolio together and not have it treated as a sale. And then reporting, as I mentioned, the transfer from foreign trust to U.S. trust requires a Form 3520. We talked about that earlier. We believe, or at least I believe, that if you pick up a trust and you move it to the United States, it's not treated as a distribution to a domestic trust, and it's not treated as a contribution to a U.S. trust, so Form 3520 shouldn't be required. Sort of like moving a foreign company to the United States in what we call an F reorganization. It's not reorganizing and liquidating companies or funding a new entity. So that there may be contrary views to that, but that's at least my view. Back to Jen.
Thank you. Well, I want to make sure that everybody can still get out at a reasonable time here, so I'll also try to pick up the speed as well so we can cover the balance of the presentation. The next bullet point here is talking about pre-domestication tax planning, which I would say in addition to the U&I considerations, these tax planning issues that I'm about to cover are probably as equally important, if not, the most important tax planning issues after dealing with U&I. So before we even consider, as Hal was explaining, either migrating the trust or appointing the assets, you just don't do it without thinking about it, right? You got to plan accordingly. And one of the first things that Hal and myself, and I'm sure others in the room also do this, particularly in today's environment where we have a lot of tax compliance issues, not just for U.S. people, but as we're seeing more and more for non-U.S. people. Hal mentioned the tax amnesties that are going on in many different countries now. And often when a client comes to us and is considering domesticating an existing trust that's foreign, there may be some associated non-tax compliance issues related to that trust, the beneficiaries of that trust, or the settlor if the settlor is still alive. And we need to consider whether we need to do some cleanup, maybe planning work, bring whoever is the entity or trust, the person who is in non-tax compliance back into tax compliance before we domesticate the trust. And the reason for that is what Hal mentioned earlier is there could be a host of issues that can come up where if you domesticate a trust that has these non-tax compliance issues associated with them, it could be optically look like you're hiding the ball, right? And we don't want to be associated with facilitating any type of tax evasion. And we're seeing more and more that, again, this is not just for U.S. people. This is for non-U.S. people. So often we're having discussions with clients who are non-U.S. And who want to domesticate that trust. For example, in one of Hal's examples, where the grantor's still alive because they just want to be in the U.S. now, but they haven't otherwise reported in their home country, declared the trust assets. We're advising them to clean up in their home country before we domesticate that trust, so that we're bringing clean assets onshore. The next bullet point there is preserving U.S. income tax and transfer tax benefits of the foreign trust. We kind of covered that a little bit here already. But, the point being is if that trust is already designed to be what I've explained at the beginning, an exempt trust or excludable trust for our transfer tax rules, when we decant the assets into a new trust, appoint those trust assets, do we lose those transfer tax benefits that we might otherwise have in the existing trust? I think Hal takes this view, or at least is more likely than not on this view, but I'm certainly comfortable that if the trust is excludable and we appoint the assets into the new trust, and that new trust is also designed properly to be excludable, then we should continue on preserving those transfer tax benefits. And the same goes for the income tax benefits. Do we want to keep them, or maybe do we want to change them? Hal gave the example of maybe wanting to pay U.S. taxes. So we might actually have a foreign grantor trust and decide that we want the new trust to actually become a U.S. non-grantor trust and be a separate taxpayer. So things to consider before we start moving things onshore. Distributing existing U&I to foreign beneficiaries. So if we have a trust that's been around for a while and has accumulated income, and the beneficiaries, we have a mixed bag of beneficiaries, U.S. and non-U.S., as Hal was explaining, we don't want to necessarily bring that U&I onshore because it would be subject to our throwback tax rules. So how can we get rid of it or cleanse it before we domesticate the trust? Well, if we have foreign beneficiaries in the picture, maybe we can distribute out that U&I to the foreign beneficiaries before we bring the trust onshore with the U.S. beneficiaries. Or in some cases, instead of domesticating, we might what I call bifurcate. And that just means where maybe we don't bring all of the assets onshore immediately. Sometimes we set up U.S. trusts and keep the foreign trust alive and only distribute D&I from the foreign trust to the U.S. trust, because only the D&I would be subject to current income taxation, and once it's appointed over into a new trust, it can accumulate without being subject to the throwback tax rules. And so sometimes we consider that as a planning alternative if we have a lot of U&I that we can't cleanse all at once.
Or leave the foreign trust for the foreign beneficiaries and move the U.S. beneficiaries' portion to the U.S. trust.
Right. And when we're considering what I'll call bifurcation or distributing U&I to foreign beneficiaries, what sometimes we have to think about is the equitableness, right, of the beneficiaries, because most want to be treated fairly. If the trust is otherwise discretionary, let's just assume most often our trusts are 100% discretionary. So in that case, we take the view that we should treat the beneficiaries fairly and equally in that case, but when we're distributing out U&I to foreign beneficiaries so that we're not taxing the U.S. beneficiaries, does that mean that the foreign beneficiaries are getting more or getting less in some cases? So you have to maybe to work with the client and structure distributions in a way that the U.S. beneficiaries might get more later or vice versa. You want to add to that? Do you have that ever come up before?
Yeah.
Yeah, okay. Yeah, that's what I thought. So let's say you're in a situation where you can't make distributions to a foreign beneficiary because you don't have any. But you do have this buildup of U&I. Is there anything else that we can do? There are some planning techniques with fiduciary accounting income. We would need a whole session to go through that, of course, but, the easiest way to explain that is there is, if you have the benefit of having, let's say, a partnership underneath a foreign trust, let's just say, distributions out of that partnership under most U.S. state laws, and we can get comfortable that this would be the same under most foreign trust laws, that distribution is a distribution of fiduciary accounting income, because it's what the trustee actually received in their hands. But for tax purposes, partnerships are flow-through. So a distribution out of a trust is generally not subject to tax. So you could have a situation where the partnership makes a distribution up to the tax level, and that distribution would mean that the FAI in that trust is higher than the DNI of that trust. And when you have situations where your FAI is higher than your DNI, and we go back to our ordering rules that we covered at the beginning, we can make distributions out to U.S. beneficiaries in a way where we're not drawing out that UNI. We've done that before for other clients, but you have to be very careful. There is some risk in this type of planning. You definitely don't want to just set up entities to do this, and just for purely tax reasons. We would want some other good non-tax reasons for using a partnership structure, which we can come up with. Moving along, can assets be stepped up? This kind of goes along with E and F can go together a little bit. We haven't talked really about companies yet. We've only been talking about trusts, and often we find with foreign trusts, the trust will own interest in offshore companies or other non-U.S. companies, and those non-U.S. companies own portfolios or other companies. So you can have tiered company structures sometimes. And the basis in those shares of the company may be historically at a low, because when the capital went in was 100, but today now the value of those shares is 1,000. So there's $900 of built-in gain in those shares. Well, that built-in gain, if you move the shares into the U.S. and sold the shares, the $90 would be subject to U.S. income tax when it would not otherwise maybe be subject to U.S. income tax. So there are ways we can step up those bases in the assets before we bring the trust onshore. We can do that by maybe selling the investments and distributing out any taxable income to maybe our foreign beneficiaries, etc. In the same notion, if we have companies, we have to be careful with our PFIC and CFC rules. It's another session that we have to cover, but it's our anti-deferral rules in relation to companies, and they attribute ownership to our U.S. beneficiaries. And so if we're thinking about domesticating a trust, you could have a situation where the trust was originally foreign. It comes into the U.S., it could be a U.S. taxpayer, which means those trusts would now be subject to these PFIC or CFC rules. Or the trust is already subject to the PFIC the trust is foreign, has U.S. beneficiaries, and the U.S. beneficiaries are already subject to these PFIC and CFC rules. So we need a plan before we bring the trust onshore. How can we possibly get out of these PFIC and CFC rules with minimal U.S. tax consequences to our U.S. beneficiaries? Sometimes we check the box on these companies, which just means it's a U.S. tax election here in the U.S., has nothing to do with the foreign jurisdiction where the companies were set up, where we can elect different tax treatment. We can elect instead of its default tax treatment of corporate tax status, we can make it a partnership or a disregarded entity, which gives you flow-through treatment and doesn't trigger our PFIC and CFC rules. We already talked about the foreign beneficiary planning. Often we see in the foreign trusts, the investments are generally going to be in foreign mutual funds because of the investment platforms that are available for foreign trusts. And these foreign mutual funds are considered passive foreign investment companies for U.S. tax purposes, or PFICs, which could also trigger nasty tax consequences to our U.S. beneficiaries. So we have to consider selling these foreign funds before we domesticate the trust. Okay, I'll go through this part really quickly because I think although some parts are important, it's really how the sausage is made, right? But when we're talking about domesticating trusts, there's no light switch that we just turn on and the trust is domesticated, right? You have to do something. And so we have to draft documents for that. And it depends on if we're in the first bucket, whether we're going to decant the trust assets or if we're going to just migrate the trust. If we're going to decant the trust asset to a new trust, we need a new trust instrument, right? We need to set up a new trust. Therefore, we need to figure out who's going to be the trustee, who is going, what state law we're going to use. Those are additional considerations that we have to plan for. what I do want to cover, because the other ones I think are self-explanatory, is we want to be careful when the U.S. beneficiaries in particular are consenting to the appointment of the trust assets into the new trust. Although it's not explicitly clear in the U.S. law, we do get concerned that if the U.S. beneficiaries are the ones exercising the power, or have a consent power, or otherwise just really involved in the decision-making process itself to decant the trust assets, that they could somehow be viewed as having what we call a general power of appointment and actually be the ones treated as making the transfer or the appointment of the assets into the new trust. And if that was the case, then you have a whole other host of tax issues for the U.S. beneficiaries to be considering.
Trustees will typically ask for an indemnification. So if they're going to transfer all the assets to another structure or some portion of the assets, they typically want to be indemnified for that, and they'll ask the beneficiary to sign off, or the new trustee to sign off and give that indemnification. Indemnifying the trustee, I think, is different than consenting, right? So if the beneficiary is put in a position by the trustee where they have to actually agree in writing to this transfer, then, as Jen's saying, it could cause, when you take that connected with all the activity of the U.S. beneficiaries maybe participating in this decision, then you may get to a position where, in the IRS's eyes, they're going to view the U.S. person as having controlled this in some way and indirectly having control over all the assets in the trust.
Right, and the other thing to think about when we're planning is, again, it's not a light switch, so it's not going to be a 5-minute exercise. Because when the other thing that the trustees ask for is indemnification, perhaps from the new trustee, and then there's got to be a back and forth between the foreign trustee and the U.S. trustee. Again, a lot of this stuff on 7 and 8 are going to be self-explanatory, but these are issues that have to be considered when domesticating the trust. The U.S. has obviously no federal body of trust law, so we have to look to each state and then consider which state makes the most sense. We want to look at case law, where the beneficiary is located, and where the trustee may be located. U.S. state income tax considerations can also be relevant. Some of our states have a state income tax. Florida does not. I know because we're running out of time. Okay, on this slide, what I want to really point out is, should the beneficiary be their own trustee? This is a big planning point that we consider a lot. First, what does the terms of the existing trust say? There might be limitations, so maybe the beneficiary cannot be the trustee. But some cases, we often want, the client wants to see if it's possible that the beneficiary can serve as their own trustee once the assets are domesticated into the U.S. And the answer could be yes, but we have to plan accordingly to make sure that if they're going to serve as trustee, would they be subject to certain U.S. estate tax issues if they were able to make distributions to themselves? So we have to put in certain restrictions there. And this is the last slide, which I think it doesn't come up as often, but I think it's relevant to be paying attention to, is foundations are an alternative testamentary planning vehicle in our civil law countries. In Latin America also has a lot of foundations that they use as an alternative testamentary vehicle because they don't recognize trusts. It's not clear in the U.S. Whether or not that foundation will be treated as a trust for tax purposes or a corporate entity. So we have to make sure we plan accordingly, because when we decide to bring that on shore, there might not be a U.S. body of law that's comparable to a civil law foundation. So we have maybe do some pre-planning and restructuring that civil law foundation to be able to bring it into the U.S. And
we are working on one now. Probably, I think it's the first one in my career where we're moving a foreign foundation to the United States without a decanting.
Yeah, and I
think you'd want a trust.
In a special way. Yeah.
Yeah, creativity.
I'm going to have to send you a bill if I tell you that.
But I think it. I think it's is it New Hampshire?
New Hampshire.
Yeah, New Hampshire is in the process of possibly enacting laws that would allow for the creation of the foundations in their state, which are comparable to civil law foundations, which would maybe, when you think about domesticating, you might think of New Hampshire. And we'll leave 10 for another day, but we just want to say thank you, everybody, for coming again. It was a great turnout, and if you have any questions, we're happy to stick around and answer them.
Yeah.